So we can get going. Our dear Father in heaven, we are grateful for this opportunity to meet together tonight. We're grateful that the semester is coming to an end, and we're grateful for thy love for us and for all thy children. We ask thee to help us have thy spirit, to seek learning and to seek thy will in all things, so that we might have thy help. We ask you to help us to gather in Israel and to understand our part and to do it. We love thee again, and we thank thee for this opportunity again, and we say this in the name of Jesus Christ. Amen. All right, so I just, you see up there on the screen, I just wanted to cover a couple of points that may be obvious to both of you, or maybe not, I don't know. And then I'll turn it over for questions. So this whole chapter, if you hadn't noticed already, is about stockholders' equity, and sometimes that's confusing to people. So I was just going to kind of go through this illustration they had on a couple of points. And the first is about issuing par value common stock for cash. So here's the example they have. Hydroslide Inc. issues 2,000 shares, $1 par value common stock. And then it gives us two different things. So prepare their journal entry if the $1,000 shares are issued for $1 per share, or if they're issued for $5 per share. And so this whole concept of paid in capital in excess of par value is confusing to some people. Other people grab right onto it. So not sure where either of you are at, but anyway. So if we issue it for $1 a share, then all we really have to do, if I can get my slide to advance, is record the cash on the debit, because our cash is going up when we issue stock. We're selling stock to investors. And then we're going to credit common stock at $1,000. So that's it. But if we were to issue it for $5 a share, then what we have to do is we show our cash going up by the full $5,000. But again, we only record the par value on the common stock account. So we would credit common stock $1,000, and then any money we received over and above that, we would credit to paid in capital in excess of par value. So in this case, when we issued that stock, we issued it for $1 a share, common stock, plus $4 more of paid in capital in excess of par value per share. So there's the first point, and you can interrupt me if there's something you have a question about, either you, Terry, or Rachel. I'm not trying to just run over you. These are areas, I guess, of common concern often when we do this chapter. So our balance sheet, if we were to go ahead and do that issue, in this case, they had already had $1,000 of shares out. So now they issued that additional 1,000, and so that's going to show up as paid in capital in excess of par value on the balance sheet. All right, so the second thing that often confuses people is the concept of treasury stock. All treasury stock is stock that has already been authorized and issued and then was outstanding, meaning someone, the public had purchased it, and then the company buys that stock back into the company. And so there's lots of reasons they do that. Often it's to either hold it in employee compensation funds, like where employee stock ownership programs. That's one reason a company will buy their stock back. Also, sometimes they just want to take some of their stock off the market. And sometimes they use those shares in payment when they buy out another business. So those are all the different reasons that they would normally do that. So here's the example. On February 1st, this company, Mead, acquires 4,000 shares of its own stock at $8 per share. So what we're going to do is we're just going to record treasury stock going up by the total cost. 4,000 shares times $8 per share is 32,000, and then we just credit cash because cash goes down. So you'll recognize that our common stock account doesn't change when we buy treasury stock. Instead, that is still considered outstanding stock, and then we subtract it off at the end as treasury stock. I think that kind of is confusing at times too. That's what it would look like on the balance sheet. So at this point, of the 100,000 shares that are issued, 96,000 of them are considered outstanding, and 4,000 of them are considered treasury stock. All right. And then the last concept is the concept of cash dividends. So remember, a dividend is just a payout of the profits of the business to the owners, to the shareholders. And so here's the example. The media, let's see, Media General declare a 50% per share cash dividend on 100,000 shares of $10 par value common stock. The dividend is payable January 20th to shareholders of record. So on the date they declare a dividend, what you do is you debit the cash dividends account because you've now incurred the dividend, and then you credit a liability account called dividends payable because you're going to have to pay that dividend at some point in the future, but you haven't paid it yet. Then on the date of record, that's the date that if somebody owns the stock, they'll get paid that dividend. You don't do anything. You just know that that's the date that people have to own the stock by in order to get the dividend. Then on the dividend payment date, in this case, which is January 20th, you're just going to debit your dividends payable and credit your cash account. So that's the process by which all dividends are paid. If we pay a stock dividend, it's a little bit different because we're not paying it out in cash, right? So a stock dividend, a lot of times companies like to be able to pay a dividend, something to their owners, but they don't have the cash available. Maybe the cash is being used for operations or to buy a new building, whatever. So instead what they'll do is they'll give out some additional shares of stock. So here's the example, the Medlin Corporation, they declare a 10% stock dividend on their $10 par common stock when 50,000 shares are outstanding. And the market price is $15 per share. So what that means is if we do a 10% stock dividend, it means we are going to issue an additional 5,000 shares. Okay, 10% of the outstanding shares. So if we had 50,000, 10% of that is 5,000. That's where I got that number from. And then we're going to record that 5,000 shares. You'll see that they have, it's a $10 par, so 5,000 shares at $10 par is going to be an additional $50,000 to the common stock account. Plus, there'll be an additional paid-in capital over and above the $10 of $5 per share times the number of shares that we issued through the stock dividend. So now our total paid-in capital will be $75,000 more than it was before we did the dividend. So whenever we do a dividend, we have to pay for it somehow. In other words, that money has to come from somewhere. Even if it's not cash, the money to pay for those shares, so to speak, has to come from somewhere. So where it comes from is retained earnings. Remember, retained earnings are just the company's profits that have not been paid out to the shareholders. So when we do pay it out to the shareholders, whether it's cash or in this case a stock dividend, it's going to reduce our retained earnings account. You'll notice that the stockholders' equity, total stockholders' equity, is the same either way, but we'll have more outstanding shares after a stock dividend. Does that make sense? Any questions about stock dividends? I think they get confusing sometimes.
They are confusing at times. I think I understand it looking at this.
Okay.
I've dealt with these things often enough. I should understand them.
Yeah, it depends on how often that really is. You know, there's lots of things in accounting that even, you know, a normal accountant doesn't do every day. So if you have a task that you end up doing once a year or something, usually you have to like look it up each year again and go, how did I do this again last year? Where there's other things that you do daily and you get really good at those. And then finally, a stock split. What a stock split does is it reduces the market value of the shares. If it's a 2-for-1 split, that means the value is cut in half, but the number of shares outstanding doubles. And so this is just another. Companies like to do this because they like to keep their market price down. With few exceptions, there's a company called Berkshire Hathaway that has a market share price of something like, I don't even know what it is now. I haven't looked in a while, but hundreds of thousands of dollars for a single share. But most companies like to encourage investment by keeping their share price down. So what they'll do is they'll split the shares, and that will create more shares, but the shares are worth less. The value to the investor is the same, right? If I have 1,000 shares that are worth $5 each, then my value is $5,000, and if they split it, then I'll end up with 2,000 shares that are worth $2.50 each, still $5,000. But a lot of people like them as investors because as the company grows, then they have more shares growing with it. Anyway, so that's a stock split. It'll decrease the par value, but it won't actually change the total value of the stock because it's the same amount of stock dollar-wise. It's just more shares of it out there. So here's an example. So this is that same company, but instead of doing the dividend, they split their shares on a 2-for-1 basis. So before the stock split, their common stock was worth, or not worth, but it was issued at par for $500,000. And after the split, it's still $500,000. No change. Okay. So the total paid in capital, the retained earnings are all the same. The total stockholders' equity is all the same, but the outstanding shares doubles from 50,000 to 100,000. So the only thing that really changes here is the number of shares out there and then the par value per share. So that's kind of how a stock split works, at least a real quick explanation of it. So any questions or thoughts about that before I move into to either your questions or to work out this problem that had a student request?
I'm good.
Okay. Rachel, do you have any specific questions you wanted to go over or cover?
I think I'm okay, just as long as we go through the problem.
Okay. And so I'll go through, actually, I think this was your problem, right, Rachel? 11-2A, and specifically the earnings per share portion and the return on common stockholders' equity, correct?
Yeah.
Okay. So I'll start with that, and then if there's other questions about the problem, I can backtrack to them.
Okay.
So I'm going to stop sharing my screen for a second and pull that up. I think I already had it open. And Rachel, I apologize. I tried the best I could over typed out email, but I don't know if I was able to be very clear. So hopefully this is helpful. So this is part D of problem 11-2A, which is in the second homework part 2. And part D asks to calculate these ratios, and they have the payout ratio, the earnings per share, and the return on common stockholders' equity. And if I remember right, Rachel was asking specifically about earnings per share and return on common stockholders' equity. What I'm going to do, and just mostly it's confusing, like where are those numbers coming from? Is that right, Rachel?
Yeah.
Okay. I'm going to bring a little Excel spreadsheet over here and see if that will help us at all. All right. So to figure out our earnings per share, we've got a couple things happening, right? It's our net income. So it equals our net income minus any value of our preferred stock. And then we divide that. Let's see. We divide that by our average why am I all of a sudden drawing a blank? Our average number of shares. So average outstanding shares. So that's kind of the formula. So let me show you where we get each one of those from. So our average outstanding shares is actually going to be our beginning shares minus any preferred, the number of shares of, or I'm sorry, let's see, minus our beginning common shares minus any shares of treasury stock. And it's that, whoops, I spelled stock with a K. So it's our beginning outstanding shares minus treasury stock plus our ending outstanding shares minus treasury stock. And then we divide it by 2. So that's how we find our average. Okay. So our net income, that's pretty easy. So we can scroll all the way up to the beginning, and it tells us right here that we determined that our net income for the year was 200. Whoops, was two. I'm having a hard time here.
Likes to do that.
Well, it's just Wiley does some weird stuff. So our net income was 277,400. And then our preferred stock, we can see it doesn't tell us this. Let's see. Our preferred stock
7%, 100%, $100 par.
is, let's see. Stock. I'm missing where the preferred stock number is. This is what's so hard about it, right, Rachel?
Yep.
Let's see. So here it is. So they had, let's see, issued common, purchased, declared a dividend. Oh, it's our preferred, not our preferred stock. I'm sorry, it's our preferred dividends. That's why I was getting confused by it.
Oh, okay.
So it's our net income minus our preferred dividends. So
Right.
That's why I was like, I remember I had to figure this out. So here's their 7% cash dividend on preferred stock. And we know that our preferred stock is $300,000. So our preferred dividend is going to be $300,000 times 7%. Does that make sense, Rachel?
Yeah.
Okay. So our preferred dividend is going to equal the value of our preferred stock times the dividend rate, which is 7%. So $21,000. Remember, that's a subtract. So there's our numerator. Whoops. Is just our net income minus our preferred dividends. All right, so our denominator now is a little bit tougher because we have to figure out, well, actually, the first part's pretty easy. So in the beginning, to figure out the number of shares of common stock that we have out, what we do is we take the value, I'm gonna make this a little wider, the value of that common stock right here, $1 million, and divide that by the stated value of $4. And that will tell you how many shares of common stock are currently outstanding. So our beginning outstanding shares equal $1 million divided by $4 stated value, or 250,000 shares. That's the amount we have outstanding. And then it's our outstanding minus any shares of treasury stock. And it tells us right here, treasury stock has 5,000 common shares at this point. So we have, at the beginning of the period, the beginning of the year, we have 245,000 shares of common stock Now to find it at the end, we're going to have to actually scroll down here to where we put together our balance sheet at the end of the period, and we're going to use this amount now. We have common stock of 1,020,000. So we're going to say the value of our stock is 1,020,000 divided by the stated value per share, which is $4. So now we have 255,000 shares of common stock outstanding, and then it's less any treasury stock. Unfortunately, this won't tell us how many shares, so we have to go back up and like figure it out, which is kind of a pain. So we have to say, okay, we had 5,000 shares of treasury stock, and then on March 20th, they purchased 1,000 shares of treasury stock, and it looks like that's it. So we're going to have the 255,000 shares minus 6,000 that are in treasury stock. And Rachel, right now, I think you're thinking, no wonder this was hard to figure out. So that's the number of shares we have at the beginning, the number of shares we have at the end. So to find our average, we're just going to take the number of shares we had at the beginning plus the number of shares we had at the end and divide by 2. Did that make sense at all? Any questions about that?
I don't think so.
So,
Makes sense.
so really all you're doing to get this number is you're taking the dollar amount of the common stock account divided by the stated value per share minus the number of shares of treasury stock. And then the same thing at the end, the dollar amount of the common stock account divided by the stated value, which is $4, minus any treasury stock. And in this case, there were 6,000 because they'd had 5,000 and they'd purchased an additional 1,000. So that's how I got these denominator numbers. So then to find the earnings per share, now we just take the numerator divided by the denominator, and it's 1.04. Does that help? Is it better than trying to explain it in an email?
Yeah.
Okay.
That confused me a little bit.
What confused you?
The beginning, outstanding shares minus treasury stock. The ending, outstanding shares minus treasury stock, but you took the whole treasury stock even though you already subtracted it from the average, the beginning outstanding shares.
Right. Well, this is the number of shares I have at the beginning of the period.
Right. Minus,
Which is,
okay.
And then this is the number of shares.
Okay, so let me think. I'm trying to figure it out. So you have, at the beginning, you have the shares minus the 5,000 common shares.
Minus
but then at the end, when you had to subtract the 6,000 shares, that's where I got confused because you already.
Right. Okay. So on January 1st, I have 1
million.
Whoops. $1 million worth of common stock at $4 stated value. So I've got 250,000 outstanding shares. And then I have 5,000 shares of treasury stock.
Right, I got that part.
So my total outstanding shares is 245,000, right? That part's pretty easy.
Right.
At the end of the year, on December 31st, I now have $1,020,000 of common stock divided by $4 stated value. So I have $255,000 worth of common stock. And then as of this date, so the end of the year, December 31st, I still have these 5,000 shares of treasury stock. Okay. Plus, I've purchased an additional 1,000 shares. So at this point, I now have 6,000 shares of treasury stock.
Right. It came to me as you were doing it.
Okay, good.
That the total has all the common stock, even if part of it is treasury. So.
Right. So that's why we have to subtract it.
That's why you have to subtract the total.
Correct.
I was like, but you subtracted it from the beginning. I got it now.
Okay, good. Good. And then to find the average of that, you just add the two together, divide by 2.
Right.
Okay. All right. So the second one is like unto the first one, which is our return on common stockholders' equity. So again, that's going to start with, I'm just going to put return on common stockholders' equity. And that's going to be our net income, if I don't hit caps lock, net income, minus preferred dividends, divided by our average common stockholders' equity. So that's, again, going to be our beginning common stockholders' equity plus, whoops, now it's freaking out, our ending common stockholders' equity, if I can type, and then divide the whole thing by 2. Okay, so again, I know that you know that already, and that the real question is, where do I get the numbers from? So our net income, the same as before, we pull that up at the beginning. It's given to us in the problem, 277,400. And our preferred dividends, just like before, we figure out by saying, okay, I have $300,000 in preferred stock and it paid a 7% dividend. So it's $300,000 worth of preferred stock and 7%, or $21,000. So my numerator is my net income minus my preferred dividends, same as before. But to find our common stockholders' equity, we have to do this. There's a number of things involved in our common stockholders' equity, and they include our, let's see, where does it give us? So here's our common stock account, which is $1 million. Our paid-in capital in excess of stated value on common stock, which is $480,000. Remember, this is just common stockholders' equity, so we're not including preferred stock. Our retained earnings, and then minus our treasury stock. And that'll give us our common stockholders' equity at the beginning of the period. So really, again, you're just adding together the capital stock account, the paid-in capital in excess on the common stock, retained earnings, and subtracting out the value of the treasury stock. So that's going to be my beginning common stockholders' equity. I can look down here at the balance sheet I created at the end of the period and do the same thing. So now my common stock is 1,020,000. My paid in excess in capital of common, paid in capital in excess of stated value on the common is 490,000. My retained earnings at this point is 781,600, less my treasury stock, which is 48,000. So my denominator then will be to take the beginning common stockholders' equity plus the ending common stockholders' equity and divide it by 2 to get the average common stockholders' equity over the period. And then my my return on common stockholders' equity will just be the numerator divided by the denominator. So 11.7%. So my question, is that helpful? Does it create additional questions? Anything I can try to answer for you?
That one I understood more
Okay.
now, so we're good.
Okay, good. Well, I'm sorry it took us 3 days of back and forth to finally get to where you feel better about it. sometimes is the challenge of online. I guess it's a challenge in face-to-face class too, if your class only meets twice a week, you know.
Yeah.
Anyway, okay. Any other questions or problems I can work out? I think it just yanked down because all the screw bolts all the bolts that hold it on there. Let's see, I think someone else showed up. Who was it? It was Catherine. Hi, Catherine.
Hi.
So I don't know when you came in the middle of that, but it was kind of a lengthy, probably, hopefully not so overdone that it was more confusing. Like when someone tries to teach you a new game and they like try to tell you all the rules instead of just, you know, playing a practice hand or two. Any other questions? I also don't want to keep you any later than we have to, so I'm happy to finish up if we're good.
You'll post this soon, right?
I always forget to post it. That's part of my problem. I will post this soon, like as soon as I can upload it to YouTube, which should take about 15 minutes.
Okay.
Let's see.
Oh yeah, sorry. I've had several people asking about the quiz. Like, does the quiz really only have one question? And the answer is, it's not supposed to only have one question, but I can't get anybody at BYU to fix it faster. So if you get it done while it only has one question, that's like an easy 100%. So
As long as you get that one question right.
It's true, right? Yeah, exactly. It's like this big risk, but not really. Anyway. So yeah, for some reason the quiz has one question, and I'm sure it's supposed to have 10, but for whatever reason it only has one, and it's not something I can update on my own. So I just had to put in like a work request to have that done.
I've got to try to get this done tonight.
Well, it's due tonight, right? So.
Is it due tonight?
Oh no, well.
Saturday.
No, tomorrow night, right?
This is part 2. Sorry, it's part 1 that's due.
I thought part 1 was due tomorrow. Oh, wait a minute. Is part 1 due today and then part 2 is due tomorrow?
Part 1.
It was Friday and Saturday instead of today. And
yeah, it's Thursday and Saturday. But part 1's. What was that?
I thought it was due Friday and Saturday, but
no, it's always been Thursday and Saturday.
Okay.
That's
I just usually have it done this. Today has been a crazy day for me, and I haven't gotten any schoolwork done. So other things that have come up that took me away from my schoolwork.
I understand. That's my whole life.
Yeah, somebody tore my car apart. Well, I say tore it apart. They stole the front grill off of it has 2 grills and they stole the bottom one.
I guess they really needed a bottom grill.
Yeah, they ripped up the there's like a, like when that when you pull up to a curb and sometimes you hear rubbing and there's like the thing under there. That whole plate that's under there, they pulled it down and the grill. So anyway.
Okay, so Catherine, are you good? Do you have any other questions, or you're like just get it posted and we'll be good?
Because I am struggling really, really hard on this chapter. So just if you could post it and then I can go and watch it. That'd be great.
Well, and we didn't do the whole problem. We just did part D.
That's okay.
Anyway, okay. And Rachel, are you good? Do you have any other questions?
I think I'm okay.
Okay. Well, then why don't we say a prayer and get out of here, and then you can go watch Stranger Things season 3 or something. I don't know what you guys are watching, but
I got to do the homework.
I feel like every season of that show, the language gets worse. So like, then you try to watch it on VidAngel, and then you're like, this is terrible. It just cuts it up so bad it's hard. So anyway, I'm not complaining. I'm grateful to live in a world where we have things like VidAngel, but frustrating at times. All right. Okay. Can I get a volunteer for the closing prayer?
I'll say it.
Okay, great. Thank you.
Dear Heavenly Father, we thank Thee for this day. We thank Thee for this opportunity that we've had to been together to study our accounting, to learn more of the things that we need to learn. We thank thee for being with us and watching over us. And we ask that thou continue to be with us and help us as we continue our studies, that we may feel thy spirit and do the things that thou would want us to do. And we say these things in thy Son, Jesus Christ's name. Amen.
Amen. All right. Thank you. Have a great night.
All right. Thank you.
Bye.
Bye.